Chart of the Week with Redmayne Bentley.
You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to Bill Rook from Redmayne Bentley. Bill, what are we going to start with this week? Which chart would you like to look at first?
I was going for the energy chart. The
XLE. Okay, let's get that one open. All right, so what does this tell you?
Well, what I was looking at is going on the rules of the Stock Traders Almanac, which is the best performing sectors generally outperform for the whole year. And this has come up as one of them. This one actually is only down 1.78% in January against an 8.56% drop in the S&P. And this is number three of the selection. I've started off with this one. So our focus would be for the year on the energy sector as one of the three sectors to go up. Now, the other thing behind that is I believe that when the market does recover, we're going to get the larger shares coming through, and it will be the larger shares that you'd find in the S&P, of course, the largest 500 largest shares. So we'd go fishing in there for the likely winners. So that's one sector to go for. I think it's going to be very much a sector-orientated market. I think it's very, very tricky, and I think we just stick to the sectors that are the strongest ones and work with those.
Okay. Now, what else do you want to look at?
Well, I've got the XLV, which is the next one. This is the healthcare index, and this is the best performing against the S&P. Now, it doesn't look very much on the chart itself, but actually against the S&P, the pink area, you can see against the S&P, which would be 0 on that chart, as was the other one. This is up nearly 19%, so it's rocketing away. That's on the year, but on the month, it's down about 1.21%. So this is certainly a good sector to look at, or certainly for stock picking. And later on, I want to look at a couple of smaller shares that will fit in possibly to the more aggressive portfolios. But this is certainly a runner, this sector.
Okay, well, let's do that now. Let's look at some of those more aggressive shares that you'd like to look at.
Okay, the aggressive share, first one is Geron, ticker GERN.
Now this is Geron Therapeutics. This is a biotech firm.
Yeah, this is the thing. Yeah, it's all in stem cells, and the new president's sort of given the go-ahead for stem cells to go through, and you can see where I've highlighted with the circle there. This share, it's 65% above its 200-day moving average. One thing to be said about the share, the volatility levels are high here. My preference is generally to buy when there's no volatility. Now you can see the share is more than 50% outperforming against sector. The sector is performing well against the S&P, and the actual real strength, underlying strength behind the share is also very, very high. So this is a star performer. The good news is the volume is going in behind the share. The cautionary news is it all is it a pipe dream? Is it sort of expectations running ahead of events? A lot of the bio stocks will get that sort of head of steam.
Well, that's
a lot of
true,
expectations.
but pipe dreams can take a stock price quite far.
Yeah, it can do. Absolutely. So this is what I'm saying is a measured amount of the portfolio rather than going nap on it, perhaps. This is where the growth is going to come from, I think, stem cell research. It's very, very exciting areas. Whether the share price is actually, the events have got to catch up with the price to suggest there's value there is something else. And if you're a trader, then you wait for the next breakout point to go in there. So this is very, very interesting, this share.
Okay, Bill. That's an interesting one to look at. Now, the next one is actually called Stem Cells Inc., isn't it?
No clue to what this one does.
Precisely.
Yeah. This one, again, likewise, it's had a couple of false breaks. Now, this one, at the bottom, what I've got down here, I've got the most interesting bit is the volume level. When it goes yellow, then the volume, I think, gets interesting. And that's you can see how it's marked up with share price movement, mirroring that. So, again, it's 65% above the 200-day. Alarm bells going for traders if it closes back inside. And that occurred early November. And then it came all the way back down again, and it's trundled up again, attacked that higher level, and it wants to go higher, but it's consolidating at the moment. A very, very interesting share again, also outperforming in the right sector. Now, again, this is in the healthcare sector, so it's really, really, these are sort of things that go on to make up a very, very exciting market. If you're just thinking, well, other things aren't working, but if you look around, you will find winners, and I think this is the area to start looking for this year, I think.
Very interesting, Bill. Thank you very much.
Pleasure.
Okay, now we've got a couple of others to look at. There's
What have I got?
XLU.
XLU's utilities.
Right.
This is another winning sector, the top three winning sectors. I mentioned already we've had healthcare sector, we've had energy. This is the utilities, a very dull sort of, but this is probably the best performing sector in January, only down 0.17%. And this is looking quite strong relative to the S&P. So all these are sort of your benchmark. S&P, don't forget, was down 8.5% in January. This is quite strong.
Yep.
And we talked earlier, Giles, about the effect of the January effect. I mean, sort of, and a lot of people say, yeah, the Stock Traders Almanac. What do we do with January? And my research has turned up between 1950 and 2008. There were 22 Januaries which were down, which were actually closed lower on the month. Yet for the full year, we had 11 of those years were up and 11 were down. So
that's really no help at all.
It isn't really. I mean, it isn't really actually. And the 5 worst Januaries prior to this last January, actually the markets closed up, and the 6th worst January was last year's. And the market did close down. So we have a sort of a mixed match of does that work? Far more interesting, I reckon, is research done by Jay Keppel, sort of between 1944 and 2008. He looked at the last 5 days of January, and when they were actually up on the last 5 days, the markets did very well on the rest of the year. So £1,000 invested in those times when the market when the last 5 days are up would have yielded $42,786, an average compound return of about 11%. Whereas if you'd done the other converse of that, you'd have been down on a basis of 0.1%. So I mean, this is I think very interesting. I'd say the number of times the last 5 days up in January have been 40 between those dates, and that's and the years gone on to become a 33%. 33 times have the years actually closed up. So it's 83% hit rate. So if you've got a strong last week in January, the chances are an 83% chance the market will actually close up on the year.
And how was this January, the last 5 days of this?
Well, this January is bad, so it's not a good one.
Right.
So it's
bad on both. It's bad as far as January goes, and also on the last 5 days as well.
Absolutely, yes. Yeah, it was bad on the last 5 days. Yeah. So how one attack that or approach this market? Yes, we go for the best performing sectors again. That's number one. And also, the other way of looking at this is what does well in bad markets, and that'll be gold. And we looked at that last week, and that will come up as a continuing theme throughout the year, I'm sure, is that we look at defensive issues, utilities and gold certainly will be prominent, I think. Certainly when markets behave badly, we have gold mining sectors doing very well, and the underlying gold should be better than most.
And also, you mentioned about gold being flagged up on this last week, and of course gold's done very well. I mean, it's come back a bit in the last day or so, but it has been up to a 6 or 8 week high, I think. So, well done for spotting that, Bill, and we will chat next week. Thank you for your picks.
Look forward to that. Thanks, Charles.
Chart of the Week with Redmayne Bentley.